This is InvestTalk, independent thinking, shared success.
Hi guys, how are you? Big time listener on the show. Really appreciate everything that you do. I am interested in the ticker BTAL. Again, it's BTAL. Looking to add that to my portfolio. Waiting to hear your review on it. Thank you so much.
All right, this is the AGF US Market Neutral Anti-Beta Fund. BTAL is a symbol. And the first two red flags. Number one is expense ratio is 1.58%. So you're paying over 1.5% for a market neutral fund. It seems just like a lot of fees that they're collecting and not a whole lot of returns. And then it's a 1 star out of 5 on Morningstar. Not that great. Now, so far this year, it looks great. It looks like a rock star. It's up 8.7% on the year. Certainly much better than the broader market, and especially long-only funds. So in a time like this, it does shine. But, these uncertain market conditions tend to go away at some point. Markets tend to move higher. So if you're looking at this tactically, this might be a decent way to go about it. Or you could just short the overall market, right? It's up as typically about as much as the market is down. So I think you're maybe chasing returns, chasing the performance. But if you're looking for a hedge and you're looking for this as a trade, like I said, to bet on the downside of the market, then this would be, a decent way to do that. Overall, I wouldn't be buying and holding this because of the fees, because markets do tend to go up. But for short-term tactical way to hedge against market downturns, I have no problem with it for a short period of time. Let's go take a live call. Sammy from San Francisco looking at Meta.
Hey, Justin, thanks for taking my call. I wanted to actually ask you about Meta and also about the larger sort of ad spending, online ad spending. I did hear you yesterday, your commentary around Google and Meta not doing very well going forward, given we're expecting, tough, it is a few months, right? Tough few months for the economy. And Meta just came out with their earnings, this afternoon, and they're giving very positive outlook. I'm trying to sort of understand whether it's a good time to kind of keep holding Meta, because I bought Meta at 572. Do you think I should hold on to them or just dump and run for now and then wait for a lower price point to get in? What are your thoughts there?
Yeah, I would not want to own it in this environment. Despite the earnings, their estimates for the full year and going forward from analysts continue to come down, and that's mainly because they've had a huge amount of revenue recently come in from companies like Temu and Shein that are producing in China and selling very, very low value goods here in the United States. And this is how they access the US market, is through advertising on the Meta platforms. And I just don't see that as something that's going to be sustained, especially with the de minimis being dropped. Even if there are trade deals, will that de minimis, will they start going back to that de minimis? I don't think so. So I think it definitely hurts a lot of the business models of the smaller and even large players like a Meta, like a Temu or Shein, that have been utilizing a lot of their platforms. And so I could be wrong. Maybe they hold up, but historically in a recessionary environment, when people are spending less, which if you look at consumer confidence, they certainly are likely to spend less going forward, especially if the labor market does turn, which the ADP numbers today gave a hint at, then the advertising will certainly slow. So no, once again, I could be wrong. I'm one opinion. So, you want to do your own research, but that's where I see this settling out at. And so I don't expect, this little bump, which it's up, let's see. Yeah, decent rally after hours. But to me, this is a chance to get out as opposed to jump in.
from the state of Washington. Thank you guys for an entertaining and educational show. My question is regarding the stock LDOS, stock symbol LDOS. Love the industry. Just wondering what your guys' thoughts are on the stock. I'll listen back to the show for the answer. Thank you guys so much.
All right, looking at LDOS, LDOS is the symbol. Most of you probably interfaced with their products if you've traveled much. They make the millimeter scanners that you go through at the airport typically. And obviously the deployment of those has been a big boon to their business. They're in $4.38 back in 2018. This year, they're supposed to make $10.68. That's up 5% from last year, and then up another 8% for next year. Now, those earnings trends are turning negative, however, and so you don't like to see that. And that's pulled back. It's down 27% from its 52-week high. And if travel is down, then are you going to need as many machines? Need as much maintenance? Probably not. Obviously, if the government is looking to trim expenses, it's a pretty bloated, the national Homeland Security, it's a pretty bloated industry, probably doesn't need more of this. And that's probably the biggest worry. Now, it is a very good business. You have minimal debt. That's positive. Return on equity is 28%. Free cash flow at $1.2 billion on a $23 billion enterprise value. That's about a 5% free cash flow yield. It's not amazing. It's not terrible either. So I think it's okay. My main issue is just the chart. It was down well before the tariffs and the recent fallout. It peaked out back in November and is now kind of in a downtrend. Its moving averages is kind of flattened out, so it's kind of neutral from a technical perspective, but leaning on the bearish side, especially if you zoom out on a weekly chart. It's found support around its 100-week moving average, and that's a positive. But if it rolls over once again, that's no longer going to be good support, and we'll probably head back down into well below $100 per share. So that would be my worry here. I like that it's non-cyclical. That's probably my favorite thing about it, but I don't like the earnings trends. I don't really love the chart either. Even though I like the business, it's still not getting me excited to jump in at these levels. So I'm passing on LDOS, LDOS. Let's go answer a question from our YouTube channel. CJM says, what are your thoughts on Shark Ninja SN? Thoughts on long-term holding? If the revenue looks good and they've got very good products, just worried about competition. All right. Shark Ninja SN is the symbol. And this is a company that makes home appliances. Think of the Ninja blender. And so they make food preparation, home environments, there's some beauty categories, cleaning categories as well. So fairly well diversified, but you're spending money on your home. That's what you're buying with Shark Ninja, is how much are individuals buying new gadgets for their kitchen. It sells vacuum cleaners, cooking pots, fryers, hair dryers, etc. About $11 billion market cap. No debt. That's great. About $300 million in free cash flow. 26% return on equity. I like that. Let me look at the chart here. Obviously, the consumer is slowing down. And this has had a big move over the past few years. And it looks to be rolling over. Peaked at 120. It's now in a downtrend. Earnings for this year is supposed to be $4.86. But once again, those estimates are coming down. And then where are their products made? I would imagine, I don't know this, I'd imagine a lot of their products are made in China. So there's probably some tariff risks here. So I'd pass on this. I don't think those tariffs are going anywhere. Oh, they might go down soon, but are they going to go to a level that makes these business models of names like Shark Ninja still viable? Probably not. So they're going to be moving, probably manufacturing. That's going to take a while. That's going to weigh on earnings, going to weigh on cash flows, going to weigh on the the price of the stock. And so for now, I'm passing on Shark Ninja. I think there's too many risks overhanging that name and the industry. Now, let's go over and talk about stock and bond correlation. Over the past 6 trading days, stocks and bonds have been correlated. It means they're rising together and falling together. And today it marked another day, right? Modestly higher on stocks and modestly higher on bonds. Now, you might think that's a good thing because no matter kind of what you own, you're probably making a bit of money today. Problem is that over a longer period of time, they tend to be inversely correlated. That's why you have your standard 60-40 portfolio. They offset each other's risks and creates a nice, steady long-term growth. But when they are correlated, you can have much bigger losses, like 2022 was a good example. Rates were up dramatically. That means bond prices were down dramatically. Liquidity was drained from the system, and you had equities fall considerably as well. So that was the first year in a couple decades where you had the double whammy of equity and bond market volatility, bond market losses. And going into Liberation Day, you had a period where there was a lot of inverse correlation. But after Liberation Day, they become far more correlated. At first, they were inversely correlated. You had bonds rallying for a day or two. And then, as we saw soon after, rates on treasuries rose, even while equities continued to struggle. And ever since then, they become more correlated, not to the downside, but to the upside. But you still have to watch for this because it's very important to understand the dynamics within those markets, the correlations. And if they are rising together, the worry is that if we naturally have some sort of weakness in equities, bonds will roll over and find weakness as well. And the question is, why is this happening? Well, first, inflation expectations have been relatively stable in the bond market. But it's more, so it's not that. It's not the inflation worries that's really hitting the bond market. It has more to do with the policies that are unpredictable and that investors, especially abroad, are having second thoughts on where they're allocating their capital and who they're allocating their capital to. And increasingly, they're trusting the US process a lot less. Remember, everything's relative. Are we still the cleanest dirty shirt? Yeah, maybe. But we're also a lot dirtier than we were just a few months ago. And so while we looked relatively poor, we're looking as dirty as the pack. And in some instances, maybe even dirtier now. Does Europe, even though they have their issues, do they have a stronger sense of the law and following due process, shall we say? That's a question now. We used to be that shining beacon on the hill, and the rest of the world is looking at us less favorably. Just look at the Canadian elections recently and the acceptance speech of their new leader. And so that's really what is driving that negative sentiment towards our bonds and that correlation that is becoming more aligned with equities. And so what you want to see actually is an inverse relationship. You want to see those moving in opposite directions. And that would mean that, hey, equities are down, flight to safety, and our bonds, our treasuries are a flight to safety once again, right? Viewed as safe once again. And if that continues to come undone, that becomes a problem for the broader market. Now let's drop in another fresh listener question at 888-99-CHART.
This is Dan from Wall Street, and I have a question about CDs. If I purchase a 3-year CD would I get a tax document at the end of each of the 3 years, or would I just get an accumulative one at the end of the third year? Thanks.
You should get a tax document every year. It's income to you, you earn it, and you have to pay taxes on it. So it's not necessarily like a bond. If you buy a bond, you buy it at a discount, and those rise over time. There's some complexities there in a taxable account. But for a CD, it's very straightforward. You get a yield, you get that paid out to you throughout that time period, and each year you get taxed on that income. So yeah, it's not at the end of the term of the CD. Now, it could be a no interest CD, right, where they're not paying you out an interest rate. It's like a zero coupon bond. You buy it at a discount, and then you eventually get the money back at maturity. I haven't seen a lot of those CDs. Those tend to be fairly rare. Most CDs pay out an interest rate. But you're paying taxes each year on that interest rate. Now, from time to time, we receive InvestTalk questions via web form from investtalk.com. Here's one that came in. Chris says, can you give an analysis on AIT 210? Seems like good support. Reshoring and manufacturing also seems to be in its favor. Would you add at current prices? Let's take a look at AIT. AIT is Applied Industrial Technologies. AIT. Let me pull up a couple of data points here. Now, as you would imagine, this is in the industrial space, and they distribute industrial products to the maintenance, repair, and operations market and OEM manufacturing industry. Now, you would think that it would, the onshoring would benefit them. The problem is that we did this before we were truly able to onshore production. A lot of the mechanisms of manufacturing take machinery that we no longer make here in the United States, that we make overseas. Maybe not completely in China, but in many instances we do. And so while I do think there will be onshoring at the margin, the ability for companies to truly onshore in a material way, I think has been neutered due to lack of planning. Ideally, you lay this plan out. You say, it's a 2, 3, 5 year plan, and we're ramping this up. And here's how we're incentivizing you to move manufacturing back, et cetera. And companies have the time to source the products from wherever they need to actually put a factory in operation. It's not really the case here, right? It's basically putting a gun to your head and saying, figure it out. And in some ways, some companies will figure it out. And most others, though, they just simply can't do it. So in this instance, it's more likely to cause problems for their business in the short term. And you see that with earnings actually expected to drop 1% this year. So the technicals are fine. You've had a pullback from a peak back in November, right around 283. Recent low is around $200 per share. Now we're back to 243. So about 14% off its 52-week high. If I zoom out to a weekly chart, though, that was a daily chart, I'm seeing more technical weakness. MACD's rolling over. Like I said, earnings expectations are not hot for this year. And I think the tariffs are going to challenge the broader industrial industry in the short term more than it's going to help. And so I would pass on AIT. Now let's play another caller question now.
This is Nick from Seattle calling. I'm calling about ticker symbol NVST. That's Invista Holdings Corp. This is an interesting company. They were spun out from Danaher in late 19, and they focus on dental practice and any needs for a dental office, including the drills and the equipment. Calling to get your opinion on this firm and really the biopharmaceutical and dental practice market as a whole. Thanks. I'll be looking forward to your answers on an upcoming show. Take care. Bye-bye.
All right, looking at Invista Holdings Incorporated, and as the caller said, they provide dental consumables, equipment, and services across the industry. Now, my problem with this is if I look at earnings, it's kind of all over the board. They made 212 in 2018, then earnings were down 15% the year after, then 50% the year after that. Now, I'll blame that on COVID. That's fine, 2020, right? People don't want to leave their homes and go to a dental practice, and so that was challenged. But earnings rebounded to $1.85 in 2021, but have never reached the 212 that it earned in 2018. In fact, earnings last year were down 52%. From $1.53 to 73 cents, and earnings are supposed to only bounce back to 96 cents this year. And then $1.15 next year, but those estimates are coming down as well. So what I can see here is, yes, you can blame a little blip on COVID, but you rebounded and then it recently dropped and it's trying to rebound again. It's just all over the place. So I don't love that. And if I look at return on equity, it's at negative 32%. Don't want to see that either. And then it does have a little bit of debt, not too much. Free cash flow is solid, but I just don't like the profitability. I don't like the chart either. It's in a downtrend. So I'm absolutely passing on NVST.
I wanted to get your thoughts on Best Buy. Do you think this is a good buy? I understand the environment isn't necessarily going to have an upturn right now in the economy, but for a long-term hold, a nice little dip into the consumer discretionary market in a safe company. What are your thoughts on this? Thank you.
Are looking at Best Buy, and this is a challenging one because this is historically a very profitable business. It's now the kind of the only game in town of the big box electronic retailers, right? Circuit City went out years ago, and there just aren't a lot of big competitors, especially like the Geek Squad. If you need TVs hung and computer repair and things like that, they're kind of the go-to, and that's why their profitability remains so strong. But they are in the crosshairs of tariffs, right? We'll see what the semiconductor carve-out will be and what that will look like. But certainly if prices go up considerably for these goods, they're going to sell less. It's simple as that. Now, will they be a bit more competitive than the rest? Maybe. That's an argument, right? The fact that they're heft and size, they'd be able to bargain with their suppliers for better, more exemptions or sharing the load on the tariff side. And that might put them at an advantage against some of the smaller retailers that they compete with, online retailers, et cetera. So they do have some long-term durable advantages. Would this be the best time to jump in? I would probably continue to be patient on it before I'd put new money into Best Buy. But I like that it's on your watch list. Great business to own long-term. Now, lastly, let's talk a bit about KKR and Capital Group. These are two behemoths in the private equity, private debt space, and they are launching new funds this month and in alliance with Vanguard and Wellington. And this is a strategic alliance. Sorry, that was Blackstone that's doing that. But KKR and Capital Group, they're launching their own funds themselves. Now, the devil's in the details here. What's interesting is that they clearly can't get funds off the ground that you can sell every day or that are filled with only private investments. So what they're doing is actually mixing in about 60% of the portfolio will be in listed securities, or that you can go and sell at any given time. And 40% will be allocated to these private assets. And this kind of solves the problem of, what about redemptions? Hey, I need capital. How quickly can I get the money? And that's what, if you're talking about an ETF, you're talking about a mutual fund, these funds need liquidity every single day. And that's just not possible in the private space. And so this is their solution, is more of a hybrid fund. Problem is, if you look at the average expense ratio for all the share classes that they're launching, 2.49%. Incredibly high. And that's one thing that's not understood because there's not a lot of transparency, is that these funds and whether it's in an ETF form or a mutual fund form or in the actual private placement fund that most people are buying into at their, from their large broker, these are very complex, very expensive, and not very transparent vehicles. And now what they're trying to do is they can't sell more. They don't want to be transparent with their current investors. And so they're finding ways to offload probably some of the worst investments into these type of funds, which aren't marked to market. So you don't know really what they're worth, by mixing it with actual mark to market assets like publicly traded equities. So, they're getting creative here, but it's a word to the wise that, these are not ones that you want to be holding the bag on, because that's what will likely happen over the long term, is that those that buy into these funds will be left holding the bag. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. We love those ratings. And keep in mind, if you need help understanding your risk tolerance level, how those impact your asset allocation and your broader goals, I encourage you to head over to investtalk.com and schedule a portfolio review with me. This is a free and confidential service. You need help with your 401k? We can help with that as well. And we appreciate everyone that participated in today's InvestTalk Wealth webinar. It will soon be posted to our YouTube channel. Independent thinking, shared success. It's InvestTalk. Good night.